It's 3 p.m. live from our studio in New York City. I'm Josh Lipton alongside Madison Mills. This is Yahoo Finance Live. Here's what we're watching this afternoon. Boeing shares sliding, but off the lows of the day. The jet maker, along with supplier Spirit AeroSystems, both falling sharply after a panel was ripped off an Alaska Airlines jet on Friday midair, forcing an emergency landing. All 737 MAX 9 jets remain grounded, but reports say the FAA has approved an inspection method for airlines, meaning they are a step closer to being put back in service.
And a bidding war for Bitcoin ETFs, the market eagerly waiting on the Securities and Exchange Commission whether it will approve spot Bitcoin ETFs. Now, ahead of the decision, the issuers unveiling their fees for the funds, and it's a race to the bottom. We're going to have the full breakdown ahead.
And a 27-year relationship coming to an end. Tiger Woods confirming that he's ending his partnership with Nike. It's unclear which company will be his next sponsor, but we're looking at the possible options ahead.
Let's get you up to speed on all of your markets action today. Finally, Josh, a break away from the red on our screens. Of course, in thanks to big tech, right? Started the day with NVIDIA unveiling a new chip that complied with regulations coming out of China. You can see that that is impacting the major indices, all in the green today, even the Dow, which was heavily impacted by that airlines news, which we're going to talk about more in a bit. Your S&P 500 up almost 1.2%. The Nasdaq up almost 2%. I'm tempted to say it that we are just so back here because of that NVIDIA news and overall the news coming out of CES, bumping up some of those Magnificent Seven names. I do have to say, oil. I'm really watching oil stocks today. Could that, crude being down 5% today on those production cuts, if we continue to see falling oil prices, what does that do to the inflation picture in the U.S.? And does that kind of take care of some of the Fed's job for them, right?
Yeah, no, so you mentioned one rally in big tech stocks certainly having an impact today on the major averages there, Madison. Another, of course, name we're watching closely is Boeing. So let's get to that as well. Shares of Boeing falling nearly 7% in trading today. It's after the FAA grounded more than 170 Boeing 737 MAX 9 aircraft after a door detached midair on an Alaska Airlines flight. With more on markets movements happening around that decision is Yahoo Finance's Jared Blickery. Jared.
Thank you, Josh. Let's take a look at our aerospace board. Not a lot of red except for Boeing, and I'll show you another exception there. Down 6.5%. This is going to be the worst day for Boeing since late 2022, and you can see we've been in several different trading ranges here, but let me just show you historically how the stock has reacted to a couple of different events. And the first would be the Lion Air Flight 610 in late 2018, and then Ethiopian Airlines Flight 302 in early 2019. And what I've done is I've taken the stock action I've shown 1 month before the event, or 21 trading days, along with 63 or 1 quarter's worth of trading days afterwards. And you can see in purple, that was the first incident. We got a pretty steep decline, about 5, 6, 7% on the first day. Then the stock recovered pretty quickly. We did see some further fallout, but by the time the quarter had ended, the trailing quarter, we were kind of right back where we had started. Now, the Ethiopian Airlines, that second disaster, that's when we saw more fallout. There were 2 5+ down days in a row there at the very beginning. As you saw before, we're down about 6% today just by comparison. And then you can see the stock really just drifted lower and had a tough time finding its footing. And eventually it would drop pretty considerably. And let me just show you a 5-year chart of Boeing going back to the beginning of this disaster. So here's Boeing, here's a 5-year chart, and we had all of this price, actually let me put a 10-year chart, we had all of this price action up in here. Once this level went, it was a very quick drop, plus we had the pandemic. That compounded everything, but you can see we are still in the bottom end of this very long trading range here. So if we were to jump above, we would have probably smooth sailing into the 300s, but there's a considerable overhead resistance. Also want to point out that one of the biggest suppliers here, one of the companies companies most dependent on Boeing for its revenue. That Spirit AeroSystems seeing a 6% drop today. It's a more volatile stock, and if this chart looks somewhat similar to Boeing, that's because it is. This was the same time period in which Boeing was trying to figure out its footing with respect to its highs, and then this drop was the same drop that we saw in Boeing. So two very different stocks reacting the same way to a tragic event here, but not quite as bad as the earlier tragedies, which involved the human life loss, of course.
Well, Jared, this is the latest, like you said, in a series of mechanical failures for Boeing. Two fatal crashes, one in Indonesia in 2018, the other in Ethiopia in 2019, like you said, both involving those Boeing 737s. What were the stock moves then, and how does that compare to what we're seeing today?
Well, I think they were quite a bit more dramatic. The first time this happened, this would be Lion Air Flight 610. We saw about a 5% drop on day one, but then by the second time we had Ethiopian Airlines flight, we not only got that first day drop, we got a big second day drop as well. And the difference between those two time periods, I think, was just the realization that something bigger was at play here. When there was only one failure, you can see the stock recovered pretty quickly those losses. This was only a few trading days later, whereas with the second disaster, we saw it meandering down here and kind of lingering at the lows for some time, and then it just drifted lower with the sequence of bad news that was coming out. So hard to say where we're falling in line this time. It's hard to see here, but this yellow line is pretty this yellow line here is pretty comparable to the first day drops that we saw for these earlier two. So far it looks kind of the same, but I can't stress enough that these are very, very different scenarios.
Very different scenarios, both of them, though, having a big impact on the market, which we're going to continue to talk about. Jared, thank you so much. Really appreciate that background. So for more on the latest with Boeing, we want to welcome in Lieutenant Colonel Tony Bancroft. He's the portfolio manager on the Gabelli Commercial Aerospace Defense ETF at Gabelli Funds. We're also going to welcome George Ferguson, Bloomberg Intelligence Senior Aerospace Defense and Airlines Industry. Really appreciate you coming on, George. I'm going to start with you because you can't have quality control issues with aerospace. You just can't, right? So I think consumers really want to know, is this an idiosyncratic one-off, or is this something that people should be thinking about when they're booking their flights? Is this a safety concern?
Yes, I mean, first, thanks for having me on. So I think it appears to us to be very much an idiosyncratic situation, right? There's a number of 737-9 airplanes flying in the marketplace, about 225 right now, most flying in the United States. This particular airplane, one of the youngest ones in the fleet, had been in service less than 3 months. So we think those circumstances indicate that probably what happened here was somebody didn't refasten or fasten this door plug correctly initially. It could also be a fastener failure, but I think you'd see that show up in other aircraft in the fleet that were using similar fasteners. So to us, it seems idiosyncratic. Again, in aviation, attention to detail, getting it right the first time is critical. So that's not a good excuse, but it appears to be part of these nagging challenges Boeing's been having, both at Boeing and in the supplier base of getting it done right the first time in the manufacturing process.
And Tony, I want to bring you in here as well. And just so viewers understand, Tony, you have a unique background. You served as a Marine Corps fighter pilot. So I'm interested, Tony, given that background, when you saw these images, this plane midair with a panel blown out, what was your reaction, Tony? How did you respond to that? Oh, Tony, I think you're muted there. Tony, I think you're muted. We're going to work on that and bring you in a second. George, let me ask you this. So you believe maybe this is just a one-off. It's not something bigger and broader. Given that, George, I'm interested. Do you have any timeline when you think these MAX 9 aircraft can be back in the air?
Yeah, so I mean, I would guess that given that, again, it's a smaller fleet, 225 of these aircraft. They're largely in the U.S. The most are flown by United, some 70-some aircraft, and then Alaska has a bunch of them. I would expect that the FAA could get on top of this fairly quickly. I would think, I've heard already, right, they have an inspection process in place. I would think you would get a number of these airplanes inspected, a lot of these airplanes inspected within a week or two. So I think we'll really understand, a good portion of what happened here within the next couple of weeks to a month.
And George, obviously we still need the results of that investigation before we can know a little bit more. But getting to the root cause here, do we anticipate, based on your experience in the industry, is this a management issue, or is this about some of the talent turnover that we've seen coming out of the pandemic with just a dearth of talent in this industry? Which of those two do you think is the more likely cause of what happened here?
So I'm going to say that I would think that every talent issue would still be a management issue, right? So it is a turnover issue. There's been a lot of turnover at Spirit, been a lot of turnover at Boeing. But management's job is to bring in those replacement workers, train them well, train them on the processes so they don't miss anything, train them on safety, and then oversee them on the line. And if it's something that happened on the line and was overlooked, I'm going to say that's management's fault. Management needs to do a better job in that situation. So, and I do think that's probably what happened here, is that there's been a lot of turnover in these industries. Pre-pandemic, this airplane was grounded. So if you're at Spirit AeroSystems, you're probably wondering what your long-term prospects were. As your most important airplane, the MAX wasn't even allowed to fly globally. As that was getting fixed, we got into the pandemic. Global airline traffic went to almost zero. So I think, if you were at the Boeing or Spirit, you might have been looking for another job. They've had a lot of turnover. Management's job to come in now to train people to do it right the first time.
And George, I'm also interested, listen, United, Alaska, they're going to be the most impacted by this MAX 9 grounding. I'm interested, George, can we try and quantify how much they're being impacted financially in terms of just, lost profit?
Sure. So I plugged some numbers in yesterday. I used Alaska because United's a mixed fleet, right? United has narrow bodies and wide bodies. So I took Alaska, first we look at 1Q last year for Alaska, they didn't make any money. So I think they're not going to want to use that when they talk to Boeing about remuneration. If you look at 3Q, we did some numbers, if Boeing were to reimburse them for profits per airplane, based on their profitability in 3Q, as well as reimburse for salaries, because salaries don't go away just because an airplane's, grounded. We think that the total fleet, 225 airplanes, there's probably 5 million-ish per day in remuneration that needs to come out of probably Boeing, if it's their fault, to reimburse the airlines. The question will be how many airplanes will be on the ground for how long, and you do the math on that to figure out what the cost is. But 5 million per day because of the fleet with there.
George, thank you so much for your time and insight and also helping viewers try to quantify this. Thanks so much, George.
Sure. Appreciate it.
Now let's bring back in Lieutenant Colonel Tony Bancroft. Tony, hopefully we got the audio issues fixed out this time.
Yes, sorry about that. Can you hear me?
No worries. It's good to have you. So, Tony, I wanted to ask you just to set the stage, and again, for viewers to understand your background, Marine Corps fighter pilot. So just given that background, Tony, I was interested to get your response when you saw those images of what was going on midair with this plane.
Yeah, I mean, it's, I agree with what George said. I mean, obviously, very lucky that no lives lost on the flight, and everyone landed in the plane, and everyone was safe. But it was obviously a dynamic situation. I'm just happy everyone's okay in that situation.
And Tony, we were talking a little bit about the financial impact to these individual companies, but from an investor perspective, what does the recovery timeline look like here? Is the movement that we're seeing in the major stocks tied to this news today something that's going to be material, a week from now, 6 months from now?
Yeah, I think overall it's going to be immaterial to Boeing. I think I just heard the tail end of George making some rough calculations, but we don't really view it, the concessions potentially to the airlines or the inspections and whatever fixes need to take place are going to be relatively nominal. I think in the near term it might impact some production the ramping that Boeing's looking to do within the next few months of the year may impact that. Just that's a lot of it's dependent upon what the FAA comes out with and how the inspections turn out. But I think long-term, really immaterial impact to Boeing.
So you think it's a financially immaterial impact, Tony, but I am interested to get your take on, this is a bad headline. How much of a black eye, frankly, do you think this is for Boeing and specifically CEO David Calhoun? And do you think perhaps Calhoun's job is in any kind of risk here?
I think it really just remains to be, the first thing they taught us in flight school is never speculate on a mishap, or an incident, wait for the full serious incident report to come out, and then obviously discuss it in all officer meetings and safety stand downs. But I don't think, I think it's too early. I don't think we really know what the true root cause was, and if anything trying to preempt that is just going to be too early and speculative. I think overall Boeing runs a good business. They have a good aircraft. The safety record of the MAX, actually of the 737 line is on the long term is very safe, and I think Boeing is going to do fine in the long term.
Well, given that, I'm curious if you think that this is a buying opportunity for investors.
For sure, I think now is an opportunity where you can buy Boeing maybe at a lower price than it's been trading at recently.
Tony, thanks so much for the time and insight today. We appreciate you joining the show.
Thanks for having me.
We're just getting started here on Yahoo Finance Live. Coming up, we check in on a few of the top trending tickers on the Yahoo Finance platform, including a shakeup at Twilio. Plus, Apple announces the release date for its mixed reality headset, Vision Pro. We break down what this means for the tech giant later in the hour. And we have boots on the ground at the 42nd annual JP Morgan Healthcare Conference. Walgreens CEO Tim Wentworth joins the program at 3:30. Stick around, much more Yahoo Finance after the break.
Still about 45 minutes away from the closing bell, so let's get a look on some trending tickers. We're going to start it off with Merck acquiring cancer drug maker Harpoon Therapeutics. That deal valued at $680 million. Now, closing of the acquisition still pending approval from Harpoon shareholders. But Josh, this is just the start of that big merger Monday that so many of our guests called out last year, saying that it was going to be the year for deals in the biotech space. And that's exactly what we're seeing here. Maybe a little bit of a reward to Harpoon, but a ding to Merck, especially this morning in the trade. Maybe some questions about whether or not the deal was fairly priced. But it does feel like these places that have been scooping up cancer drugs and cancer-related firms, that seems to be key, especially for some of those names in the pharma space that were tied to the COVID vaccines. It seems like that's where they're all kind of concentrating a lot of their capital around.
Yeah, and Bloomberg has a good explainer on Harpoon, basically focuses on these drugs that use a patient's own immune system to kill tumor cells. Right. And Merck, though, certainly has been busy. So beefing up its portfolio in October, agreed to buy the rights to sell Daiichi Sankyo's 3 experimental cancer drugs. Then in April, announced it was buying Prometheus, which makes autoimmune drugs, for about $11 billion. Stock has not done a whole lot. It's up about 5% in the past 12 months. Although, and maybe in part because of that, the street loves this name still. I mean, more than 80% of analysts covering Merck think you should buy it.
Yeah, I mean, it's definitely had that positive reaction from analysts for some time now. So it seems like this is definitely a sign of, positive sentiment surrounding the name, that have a name like Merck scooping them up.
For sure. All right, moving on to a big move in the C-suite here. Check out shares of Twilio. They are rising today on news that co-founder Jeff Lawson will be stepping down as CEO. Chief Communication Officer Cosima Shipchandler will be taking the reins as it struggles with 2 activist investors pushing for significant changes there. So this is a big change there. Co-founder Jeff Lawson, well known, the face really of Twilio at the software company for a long time. We should also mention another longtime board member, Jeff Epstein, who's a partner over there at Bessemer, replacing Lawson, it looks like, as chairman. Separately, Twilio also said it expects to report Q4 revenue and non-GAAP operating income above the high end of guidance. On RBC's Rishi Jaluria covers Twilio and has for a long time, telling his clients the news today still leaves a lot of questions, he says, around ongoing activist involvement, potentially, he says, for more divestitures, or maybe he says an outright sale, given that you saw this new CEO already talking here, Madison, about taking a fresh look at the areas of the business that are underperforming to realize the full potential of the business. That's why Rishi says maybe divestitures or an outright sale could be on the way here.
Yeah, it's interesting because Shipchandler also, I remember seeing his name in the news last week because he sold off about $800,000 worth of shares in the company previously. Now, obviously, they're having a great day. So not a great move for his personal portfolio there when you look at the green on the screen for Twilio, but also definitely a win for activist investors, right? It feels like, given some of the news that we're seeing across the street, even when I think about Peltz or just the other activist investors that we talk about all the time, it feels like they're starting to impact some of the fundamental moves at these companies, even a company, as big as Twilio, right, Josh?
Yeah, and listen, Twilio has been dealing with some challenges. We know that the slower sales growth, those activists you mentioned have been circling. The company has responded. You saw a few different rounds of layoffs there, but we'll see what comes next with this new man in charge. Stock's up about 45% in the past 12 months.
Well, something that I know you're going to be excited about, Josh, Crocs, okay?
One of the biggest Birkenstock guy, you know that.
I could tell, given the crocodile shoes you've got on there with the cowboy boots. But this is about Crocs, right? One of the biggest movers on our platform today, surging after the company updated its guidance this morning. Crocs saying it expects record full-year revenue in 2023, up almost 11% compared to the prior year. Now, what interests me about the stellar performance of this name is when I was on the floor of the stock exchange this morning, I was asking the guys to give me some talking points for my hit about 30 seconds before air, as I like to do. And they talked about the bad forward guidance of Genesco. This is a company that has Journeys, some other footwear names that you might see at a place like PacSun if you're in the mall, updating their forward guidance, but not in the right direction for the street. And we know that a name like Nike, which we're going to get to their news in a bit, but they've been struggling on sales as well. So it makes it really interesting to look at the stellar performance that we're seeing in Crocs today. What is it about them that is making them outpace the rest of the footwear market here? Is it something more idiosyncratic? Is it that, I hate to say it, is it that Crocs are trending? I mean, maybe it's just something as simple as the footwear choice of our consumers, but you can see in the stock performance that Crocs starting to outpace some of those competitors that I mentioned here.
Yeah, I'm just looking over the analyst notes too, just kind of reacting to these headlines today. Some of the team at Stifel saying they are encouraged by the strong Q4 results and preliminary outlook, says it validates their expectations for earnings power at about 12 per share. They got a buy in the name, target of 132. We should point out, even with today's pop, the stock is in the red over the last year, though most on the street, fans, 10 buys, 4 holds, just 1 sell.
Just 1 sell, and I mean, we never get a sell, so that's not great news, but it does indicate to me, given the positivity that we're seeing in their forward guidance, that this is a name that's going to have a good year. Yeah.
All right, let's move on here. The end of an era. Tiger Woods announcing today via X that his 27-year partnership with Nike is finished. For a look back at one of the most successful sponsorships truly of all time and what's next for both Nike and Woods, we toss it over to Yahoo Finance's very own Brad Smith.
Hey, Josh. Yeah, visible on the head, chest, and shoulders of the face of golf for decades was one logo, the swoosh, prominently positioned during Tiger Woods' wins and iconic Sunday red appearances. Today, Nike and Woods part ways. Here's a look at the value of some of the deals between Woods and Nike. Woods sparked question and fodder for conversation during the 2022 Masters by wearing FootJoy shoes and a Acushnet subsidiary instead of his Nike-designed footwear with accompanying TW logo, perhaps the beginning of the end for the 27-year relationship between golf's most recognizable figure in Woods and Nike, the world's most recognizable athletic manufacturer. So what's the price action and potential tradability on the Tiger news? Well, shares of Nike, they've been trending on the Yahoo Finance platform on this news, and Nike for itself, we should note, is in the midst of a cost efficiency push, which impacts everything from headcount to product line considerations. The company is also continuing to expand Jordan brand beyond basketball into golf, global football, and American football, and Jordan women's and kids. And this Jordan brand continues to lead the brand at Nike in the overall growth, as communicated to investors during its 2024 fiscal second quarter earnings call. Next up, we got to check in on shares of Acushnet. This is the parent company of FootJoy, and they manufacture the golf shoes Tiger currently wears, plus also the parent company of Titleist, the golf ball and club maker who actually manufactured the Titleist 681T irons that Woods used in his 4 major championships in 2000 and 2001, which were actually later sold for over $5 million with Golden Auctions. We reached out to a representative for the company who says that Acushnet had nothing further to share in the immediate morning of the news breaking. The other perhaps longer shot possibility could be Topgolf Callaway, and this one is of course a Phil Mickelson fame, so we won't dilly-dally there for too long. But say you don't want to trade Tiger specifically, but want to trade the sport. Well, golf. Let's consider this. The sport has already experienced a post-pandemic surge as athletes look for outdoor activities, but is unquestionably still among the more expensive sports. Wealthier consumer groups, they may continue to spend, but equipment and apparel sales are probably going to lag the same boom that was seen during 2020. So the trade perhaps that still offers golf exposure is airlines, with routes to the most golf-forward destinations. While partnerships, they begin and end, one thing will remain for sure for Tiger fanatics. On Sundays, we wear red.
All right, Brad, thank you so much. I really hope that you are either heading to the airport to head down to Florida, or you're at least getting some Top Golf in after that fantastic report. We really appreciate it, Brad. Thank you so much.
I wish. Thank you.
Now, the Fed, of course, also in focus on Wall Street beyond Tiger Woods. Atlanta Fed President Raphael Bostic saying inflation is on the path toward the central bank's 2% goal. And Wall Street is betting the Fed will start cutting rates in March, but our next guest thinks that's just a little too soon. So joining us now, Morgan Stanley Chief Global Economist Seth Carpenter. And Seth, thank you for being here and for sticking with us through those segments. I love this quote that you have in your most recent distribution note. You say the road to a hard landing runs straight through data that looks like a soft landing. So that tells me that maybe you are just as confused as the rest of us. Help me get some clarity. Where can I look? Where can the market look for clarity about where the macro environment is heading right now?
think the labor market data is going to be the first and most important clue there. I think judging from the comments that Raphael Bostic made that you quoted, inflation really is coming down. We were sort of really early cheerleaders that inflation was going to come down without there having to be a recession that forces things down. Some of the sort of public economists out there had been saying to get inflation down from where it was, you would need a serious recession, 7.5% unemployment. We weren't convinced. We thought it was coming down, and here we are. And so now the question becomes, what's going to go on with the growth side of the economy? We got a jobs report on Friday. It was actually a little bit stronger than we thought. But the underlying trend, if you look back over the past 6 months, the past year, the past 18 months, downward trend in labor market growth. But what's important from our perspective is you're seeing a softening in hiring. You are not seeing a pickup in firing, even as aggregate demand cools down. And that for us has been why since the beginning of 2022, we've been in this soft landing camp. We feel pretty comfortable there. For a while, markets were throwing garbage at us, telling us that we were clearly wrong. The Fed can't hike that much without causing a recession. Now here we are. And the market's actually getting a little bit ahead of us now, thinking the Fed's going to start cutting sooner. Labor market data is going to be the first place to look.
And so I'm interested to follow on that, because you said like a lot of people might have disagreed with you, right? I mean, I think if we ran the tape 12 months ago, there were a lot of smart.
If you have that tape, I'd love to see it.
Yeah, I'll get it right to you, Seth. There was a lot of smart economists, though, 12 months ago, saying recession, we're going to tip into a downturn. You know, I'm just interested, why didn't we, Seth? Was it just the economy was more, it just proved more resilient to that rate hiking campaign than a lot of people thought?
I think there are a few components to it. The one sort of underlying factor is we did get a lot more support, I think, especially over last year from fiscal policy than even we judged, but I think that most people were expecting. It lasted longer. People sort of look at which year is the deficit to see when that stimulus is going to happen, actually dragged out over more time. But the real fundamentals for us really come back to the labor market. So we know that when the economy bounced back out of COVID, employment bounced back much more slowly. It didn't bounce back proportionally. And so that means the economy as a whole was kind of shorthanded. And so we've seen businesses up until very, very recently, essentially until now, hiring was for current needs and to backfill those positions. So that's given a little bit of a buoying effect to the economy. So that's one key part to this puzzle. I think the other part, though, take that same view. What usually causes a slowdown to turn into a recession is businesses starting to fire people. So they see slower sales, they see less demand, and they go, you know what we got to do? We got to cut costs, we're going to fire people. Turns out when people lose their job, they spend less. And so the economy has less spending, so more layoffs happen, which means less spending, which means more layoffs, and it builds on itself. We're just not seeing that dynamic right now. We're seeing a reduction in hiring. We are not seeing a pickup in firing.
I'm wondering if we're starting to see hints that might be on the horizon, though. If you look, you can always tell whatever story you want, as you know, if you look for specifics in the data. But, you know, underemployment up, hours that folks were looking for over the holidays wasn't as strong as they had wanted. I'm wondering, and then we, of course, had the dreadful ISM. I'm wondering if that is just what softening looks like, or if that is an inflection point away from the picture that you're painting for us.
That's precisely why you had that quotation that you read at the beginning. Anyone who wants to see a crash, anyone who wants to see the recession on the horizon will point to exactly the same data that we're pointing to, that for us is a soft landing, and for them is the beginning of the end. But I've just heard that story so many times over the past 6 to 9 months that yes, this is a slowing down, but boy, the other shoe's going to drop soon, and it just hasn't happened.
And so I want to get your take on inflation. Do we have that CPI print this week, Thursday? What are you expecting there, Seth? And just as we look now over 2024, what does just the trajectory of inflation look like to you?
So one of the unfortunate realities of this industry and data is that there's always a bunch of noise and it bounces around. So we got a particularly soft print from inflation, especially when you translate it into the PCE inflation that the Fed looks at last month. We think we're going to get a bit of a bounce back from that. Nothing like inflation taking off again, and if you sort of step back and look at 12 months in a row or whatever, all still smoothly coming down. But on a month-on-month term, we think it is going to step up again over 25 basis points on a month-on-month basis, closer to 30 basis points. And from our perspective, that might also give markets just that little bit of extra pause to go, maybe those folks over there, Ellen Zentner at Morgan Stanley, Ellen and her colleague Seth Carpenter at Morgan Stanley, maybe they're right. Maybe March is too soon.
So then when should investors be anticipating the first cut?
So our baseline very much is June, at the June FOMC meeting. But, you know, as always, that forecast relies on the forecast for all of the incoming data to fall into place like we think. There's probably some two-sided risk to our forecast. Could be a little bit stronger, could be a little bit weaker. I would say for the March meeting, we really do need to see an underperformance of both inflation and the jobs data between now and the March meeting for it to happen. The May meeting, maybe there's a little bit more wiggle room. If the Fed starts to get that much more confident, maybe they start to worry more about the real side and they cut sooner. Yeah. But we're happy to stick with June for now.
And Seth, final question here. So you're predicting a soft landing here. When you think about maybe some downside risks to growth in 2024, Seth, what would be top of mind? Would it be like the lagged effects of that rate hiking campaign, or what are you looking for?
So I definitely think there's still so much that's uncertain about what it takes for monetary policy impulses to just show their way through the economy. And we know that over the course of the year, some business debt will get refinanced and they'll do that at higher interest rates. We know that credit quality for some, especially at the lower end of the income distribution, is starting to deteriorate as it usually does when things slow down. Calibrating that just right is hard. And so you could see a pullback either from businesses or households. I would say as well, Europe, we're feeling a little bit less confident about the strength there. We think they're going to be bouncing around zero. It could have a bit of a spillover if Europe does worse than we anticipate. But I really think overall it would be something going on with financial conditions, either the tightening that we've already seen just having more of an effect on spending than we anticipated, or maybe we're not fully out of the woods with where the banking system is.
So more focused on the inflation picture here than maybe geopolitical risks, broader global risks there?
I think that's right, because for the United States, it's so hard to figure out a clear scenario where there's going to be a meaningful way of moving the needle from the geopolitical risk. We've seen times where commodity prices go up, oil prices, for example, where they go down, right. Where people pull back a little bit in terms of risk taking, but to have that really affect on a sustained basis the real economy usually takes something a little bit more proximate.
All right, Seth, we'll have to leave it there, but this was great. Thank you so much. Really appreciate you giving us some clarity. Thank you so much for joining us right here in studio. Now, coming up, we head out to the annual 42nd JP Morgan Healthcare Conference. Our very own Anjali Kamlani sits down with Walgreens CEO Tim Wentworth. Stick around for more. You won't want to miss that conversation.
Welcome back to Yahoo Finance Live. I'm here at the JP Morgan Healthcare Conference in San Francisco, and joining me now is the new CEO of Walgreens, Tim Wentworth. Obviously a lot to cover here, Tim, but thank you so much for making the time to join us. I know this is your big debut.
It is, and it's great to be here with you.
Thank you. So let's start talking about Walgreens and sort of what you have planned out. I know we just got done with your first earnings, and we had a little chat then about sort of the strategy you have, but what is it that you see is the story for Walgreens for 2024?
Yeah, I think the story for 2024 is pretty straightforward. It's re-energize the retail part of our business, both front and back of the store, in the context of a pretty tough consumer situation, right? And in the context right now of a fairly soft cough, cold, and flu season, although we're starting to see some of that emerging, as you know, more masks here than I expected to see, for example. But secondly then is, really importantly, get the balance sheet and the cash position of the company squared away. So you saw we cut the dividend, for example. That was a difficult decision, but necessary. We have significant capital reductions that we're making without impacting the underlying business in a meaningful way, and cost reductions. So there's that piece of it, but that really frees up the capital then to do the investment not only in the stores and in additional services in the stores, but importantly, the broader health services portfolio. And what you've seen this year there is what I would say getting to profitability. You know, we're recovering almost $400 million of incremental profitability, largely a reduction of losses from a couple of the key assets. And so that's the other piece this year, is not only stabilizing that, but really helping our shareholders as well as the consumer understand we are not pivoting away from the stores to a healthcare strategy, which has been somewhat the narrative. Rather, we are starting with great stores and expanding out from there a set of services that we can do across the healthcare ecosystem for payers.
Well, talk to me about that, because we know the stock has been down over the past year. You've had a lot of struggles in the retail space, many different factors, and generally speaking, I know at least in my years covering Walgreens, the front of store has always been sort of a weaker, sort of an up and down situation. So how are you trying to change the strategy to address all that?
Sure, and what I've talked about everything being on the table, there are a number of elements when you talk about the store. There's how many stores do we have? So if you look at historically, we've closed a couple thousand stores since the last 5 years, 200 more this year, and we're looking forward at what the right footprint is for the future. Secondly, the layout of the stores and how much we dedicate to healthcare versus to other retail activities. Third is the mix and the number of SKUs in the stores, so that's all on the table. I think we can meaningfully reduce the number of SKUs. It means we're going to work with fewer national brands, but we're going to be more important to the ones we work with. And then own label, which to me is way under leveraged compared to the trust we build with our consumers, and being able to get own label, which has been, it's gone up over the last couple of years, but I'd like to double own label. You can see other retailers that do a good job with own label do quite well, and the consumers find it absolutely acceptable. So those are the pieces. And then finally, turn the store managers loose. And I think the thing that's really exciting is we have 9,000 store managers, and getting them the information and frankly rearranging their incentives so that their store and their employee NPS and their customer NPS are how they get their variable comp will unleash a whole bunch of innovation, giving them some flexibility to make their stores even more successful.
A quick yes or no on that. Does that same label, own label, also include getting into like the biosimilar space? Are you looking to do that level or no?
No. Okay. We're happy that manufacturers of biosimilars, we're going to be a great partner for them as those products ultimately find market acceptance, but no, we're not going to, I don't think you'll see us building manufacturing capability.
Well, I'm interested by this retail focus, because it seems to be that when you were appointed, people assumed that you might be getting into the insurance space, more vertical integration, but I get the sense that you're not necessarily a fan of vertical integration, of VillageMD even, and just being a part of that strategy.
So, vertical integration can take a lot of forms and works really well for certain players and has worked well for players. Given where we are, it's not for us the best option compared to building out a health services strategy that is asset light, by and large, highly capital efficient, and enables the touch points that we have with 10 million consumers a day to be used as touch points for other outcomes that matter in healthcare. And so, everybody at this conference would love to have 10 million touch points a day with patients, right? And so as we sit down with health plans, they get super excited. So we don't need to own a health plan, frankly, in order to create value for that health plan and be paid fairly for it. And as that's the same as the PBMs, who we do a lot of different services for in some cases. We don't need to own it in order to actually be the most valued and trusted partner.
So is this something where you would consider cutting VillageMD out of the equation?
Well, that's, I've said everything is on the table. So first I have to say everything is on the table.
Okay.
But let me say, VillageMD is performing really well. They clearly needed to do a reset this year, and that's what they're doing very, very, very well. We view them as an investor, because we are an investor in them. We actually hold some of their debts, so we also are their banker. But most importantly for me is they are a place for us to build services collaboratively that helps them achieve their goals, and that we can then prove out and then help others with as well. So I actually like our relationship with VillageMD, but you will not see us adding to that set of investments with additional provider groups beyond VillageMD, Summit, CityMD. We're very happy that we have what we need in that respect to build solutions that can be taken out to the marketplace.
Well, talking about this strategy, scripts, of course, and volume is always one of the metrics that are used to judge the company. We've seen a lot of different changes in the past several years. Thanks to the pandemic, a lot of digital focus, mail order has gone up. And we just heard one company say that they're going direct to consumer. I'm speaking about Eli Lilly, going directly to consumer. Do you feel like that strategy bypasses you or threatens the pharmacy industry in any way?
So, a lot of it will depend on how it plays out, but what I would say in a general sense is not necessarily. When I look at the announcement that I know Lilly made, and there's a lot of details still to be forthcoming, right? And I have a huge amount of respect both for the product the products they're putting in there as well as the process they're implying. I actually think they'll ultimately conclude they want a retail partner to work with. And so what you'll have, and if you think about it, it's a very, by and large right now, a very large cash program. And what we've seen is the cash programs have proliferated because of this kind of historic cross-subsidization of brands and generics, where the generics for a patient in a high deductible plan were costing them more in their insured benefit than if they just walked in and paid cash. Well, there was a rational reason that in the history that was the case. It looks less rational now, and the GLPs are a great example where, quite frankly, it doesn't work for us, or frankly the ecosystem, for us to not be paid at least what they cost for us to acquire, plus the services to help those patients. And so I think you're going to see a continued evolution that helps the pharma company get the drug to the patient, have it be safe, have it be taken as it should be. And as you know, that class of drugs, adherence is a major problem. And I think we can demonstrate how we are a much stronger adherence engine, for example, than a mail order pharmacy.
Fair enough. And then when you're talking about where the company gets to go from here, what the growth strategy looks like, you're talking about locations and storefronts, brick and mortar, all the changes that you anticipate in the services that are being offered. What is it that you would say is sort of the key goal, the key focus that Walgreens needs to stay on in order to ensure that the story that has been its story for some time now isn't going to continue forward, that you are able to, in this tough environment, actually get the growth that you're anticipating?
Yeah, I think what you'll see, the kind of metrics that I'm going to be looking at is how many new contracts have we signed with large payers to do unique things. It's going to be how many pharma companies are now paying us to actually help recruit for their trials, because we've signed 25 contracts. We have a very large one that we're looking down the barrel of, and these contracts are actually in some cases multi-year, double-digit million-dollar contracts. They are significant. And so again, what I'm going to be looking for is ultimately, do the customers in the marketplace, not the patients, but the customers, the health plans, health systems, PBMs and pharmacies, and the pharma companies, are we winning with them, and do we have announceable, reportable things that are material to the business and don't require massive amounts of capital in order to bring them to life?
Well, we'll have to leave it there, but thank you so much, Tim Wentworth, new CEO of Walgreens. Thank you for joining us today.
Thanks, Angela. Appreciate it.
Don't go anywhere. Yahoo Finance Live will be right back.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there is more to come on this. and we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Apple shares rising for the first time this year. It's after the tech giant announcing the release date for its mixed reality headset Vision Pro. The move to the upside coming after a dismal start to the new year for Apple shares, following two key downgrades last week. So this is Apple's big new product here, Madison. This is the Vision Pro. It's a mixed reality headset arriving February 2nd. We would not expect this to be kind of an instant mainstream hit just because of the price tag here. It'll run you about $3,500. But this is an important moment because Tim Cook point here is let's get this headset into as many developers' hands as we can. And remember, of course, Apple has tens of millions of developers all around the world. That's who you got to count on here. You got to get those men and women excited, get them to commit their time and their effort, their money to creating apps and experiences for their headset, because that's what's going to drive sales. Ultimately, it's Josh and Madison at some party and you're hearing about just this killer app. It's the app you got to experience. That's what's ultimately going to breathe life into this new device.
I love the idea of us at a party talking about this Apple headset and what it's doing to the stock price, Josh.
In my head, we're already there.
Exactly. I love it. This is great. But I am curious, and you know this better than anyone, so forgive me for using your intel on this, but is there any chance that this announcement was a reaction to the stock moves that we've seen in Apple over the past week, having a really rough year-to-date start, and then we get this positive news today and then a bump in the stock for the first time so far this year? Is there any chance that they moved up the announcement of this news because of the poor stock performance? We know that they've had this headset in the works, so I know it's very unlikely, but I'm just curious if that's a potential move from them on the market moves today.
I don't, Madison, have line of sight into whether they would have moved this up. That's hard, though, for me to believe.
Yeah.
I mean, these kinds of things are usually planned well in advance, right?
Sure.
Also, with a move here like this, I don't know if you peg it on this news. It's always hard to say what moves the stock in any given day, but remember, of course, we've talked to any number of very smart industry analysts and financial analysts. They don't think this product is going to be financially material, at least in the near to intermediate term, but really it's more about Apple just kind of laying the groundwork for what at least bulls think could be an important product for the portfolio down the road.
Right. It's really interesting to me to continue to watch the VR space. We know that Meta obviously rebranding the entire company name and ticker to embrace the metaverse. I wonder to what extent that is going to be a reality moving forward. But we do want to talk a little bit more about the broader tech market moves today, starting with the big dog moving up, the Magnificent Seven. NVIDIA shares jumping after announcing that it's launching 3 new graphics cards. Meanwhile, Piper Sandler says NVIDIA's GPU capacity build foreshadows growing data tailwinds, thus potentially ushering in a new data renaissance. Piper Sandler citing this as part of key themes to watch for application software. So here for what may be in store for cloud applications and analytics this year, we have Brent Bracelin, Piper Sandler Managing Director and Senior Research Analyst. Brent, thank you for being here with us. We're going to dig more into the specifics of cloud names specifically, but starting on this chips news coming out of CES from NVIDIA, I wonder if this AI renaissance that we mentioned before, is that baked into the market already, or do you think this news gives us a renewed reason for more market euphoria around some of these AI names?
Listen, I think 24 is going to be a little bit different in that AI is known. AI is clearly driving a lot of stocks, driving markets. Our favorite AI play obviously is Microsoft, but that's very well known and very well appreciated. What's less appreciated is going one step further. Who could benefit from AI that might not be fully appreciated. And so that's where we bring up folks like a Workday. That's where we bring up folks like a Snowflake. So there are additional folks out there that in that application space that we think will actually be indirect beneficiaries. Clearly, all of the attention is being played to the Magnificent Seven for good reasons. But we think there's a broader opportunity out there for investors willing to take a little risk.
And Brent, great to see you as always, my friend. When you talk about application software, just as a vertical, Brent, I'm just interested, why are you bullish into 2024? What are the reasons for optimism?
Yeah, good question. So you have to understand the last big cycle for these cloud software companies actually happened during the pandemic. There was a forced move to accelerate, pull forward your cloud investments because of remote work. And so you had this huge acceleration in spending on the cloud application space. Unfortunately, the last 2 years have been tough. So we've had a lot of cost optimization, moderating growth. There were over 40 cloud software companies growing over 30% back in 2021. If you fast forward to next year, there's only 4. So growth is scarce again. We think we're entering a whole new investment cycle for these cloud application companies. This time it's really driven by the need to move these applications, these old applications where your data is locked up in on-prem software. You got to modernize to unlock the data and open up some new AI opportunities. So we're at the beginning of what we think is a big generational investment cycle. We saw one for a blip, a little bit of a bubble in the pandemic. We're about to enter a much more meaningful cycle for cloud applications.
So given that we're about to enter this cycle, what should investors know about how to suss out the opportunities associated with each individual name that you ran through there? Should they be looking at fundamentals, at technicals? What are the specifics? What on the balance sheet should they be looking at to determine where to go in these names?
Sure. So what we're looking at right now is a little bit of a combination of both an approach towards GARP, growth at a reasonable price, as well as taking on a little bit more risk with what could be a generational company. Let's put Snowflake in that really high multiple, but has the potential to be a generational stock in this whole AI era. Has more risk, so understand that is a slightly more risky investment because of the premium it has. But again, there's not that many generational companies out there. On the other hand, we think there's great opportunity to invest in growth at a reasonable price. Companies like Workday Software, that you have a new leadership team that has done a really good job of focusing that business. There's several new partnership and product announcements coming this year that we think could stabilize growth in the high teens, and more importantly, similar to what we saw at Salesforce this year, drive meaningful improvement in margins as that business approaches $10 billion scale. As it relates to smaller companies like a Monday, this is another very interesting company. It's viewed as a company that might be viewed in a competitive space, but they're really separating from their competitors, turning into a multi-product platform. And that's a company where we think we could get both a re-rating on the multiple as well as a fundamental improvement acceleration in their business. So it's a combination of both. It's going to be a very different year, 2024, than 2023. It's not just about the AI hype. I think there's a much bigger, broader set of opportunities looking at this group in the next cycle.
Brent, I want to get you out on this. So we know what you like, Brent. Workday, Snowflake. Here's a name you don't like, and I want to get your reason on it. Unity Software. You got the equivalent, I think, of a sell on that one, Brent. And I was just talking to Madison about Apple, the new headset. We know, Brent, I think Apple's working with Unity Software on that headset. Why is that a sell, Brent, in 2024?
Yes. Unity is a very unique company. We think it's got a very differentiated moat as it relates to technology. But the challenge is they've really doubled down on the ad network part of their business. And so it's a much larger advertising business. They're going through a leadership transition, which adds execution risk. They also tried to raise price too aggressively, and the game developers push back. We don't think the changes they've made will actually have a positive impact on their business in the near term. We actually think there's more downside than upside risk, particularly given a lot of the optimism now being generated ahead of this new Apple device cycle. It's going to be too small to even matter to the numbers, but now the multiple has a premium here that might be unjustified relative to the timeline when it will actually have an impact on their business. So the ad business is struggling. I think it will continue to struggle in the next year. Even though it's a great company and a great franchise, might not be the right time to buy it.
Brent, always love having you on the show. Thanks for the insight and the picks.
Take care.
You too. Coming up, closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned. Closing bell on Wall Street. Let's do a quick check on the markets here. We've got some green today, Madison. Looking at the major average here, green across the screen. I got the Dow up, about 0.6%, about 216 points. The S&P 500 up about 1.4%, and the tech-heavy Nasdaq tacking on more than 2%. Of course, that was big tech, which rallied today. Names like Apple and Microsoft, Nvidia. We know, of course, those names were the place to be in 2023. If you piled in about 12 months from today in January 2023, you're feeling pretty good and pretty smart. Of course, a lot of debate of whether that's still the place to be in 2024. Yeah. Lots of excitement about those names and their growth prospects, but there are skeptics who say maybe valuation after that run is looking a bit stretched. I want to take a quick look at treasuries here, Teal. It looks like yields resuming their decline. Say the yield on the benchmark 10-year just peaking ahead. It's head above about 4% here.
Yeah, it's interesting to think about the market trades today because, of course, I think Nvidia obviously leading some of those gains and some of the other big tech and specifically chips names. We have AMD up today as well, leading some of those Magnificent Seven names. But I really want to point out this consumer inflation expectations report because it showed that inflation expectations are at the lowest level since 2021. That's moving some of the rate-sensitive stocks as well today. Think REITs, think the Magnificent Seven that had seen a pullback as investors got worried that, maybe we got a little over our skis in anticipation of the Fed cutting rates. Maybe it's going to take a little longer. Any economic data like this, Josh, and I feel like today is a good indicator of what we might see coming in for the CPI report on Thursday. The market's clinging to it right now, right? The amount of green that we're seeing on our screen today, if I look at the pie chart for the S&P 500, the only section that's really clearly in the red is energy. The worst performer of the day is Boeing. And by the way, they're the worst performer year to date so far because of some of the news related to that name. But seeing a lot of other green on the screen, led by tech rather, but still seeing green across the space, and I think that's probably related to some of the macro commentary there.
Yeah, you mentioned the chips, which are so important. Nvidia popped more than 5%, hit an all-time high. You look at the SMH, which is the ETF that tracks the chips, that's up more than 3.5%. The reason that's important is even if you don't have money directly in the chips, market strategists will always be quick to point out, you follow those chips because they do tend to leave the market up and on the way down.
Well, I really want to check on shares of Boeing and United Airlines. The Air current reporting that United found loose bolts on plug doors during 737 MAX 9 inspections. And we're just getting that news. Again, United reportedly finding those loose bolts on plug doors during their inspections. This is likely going to be the news that's going to start trickling in, Josh, throughout the week as the FAA starts their investigations. My biggest question, and this is what I asked Jared Blickery this morning, I said, none of these airline names are big big enough to impact the broader market as we head into the close, which is obviously what we saw all green across your screen. But does it lead to a broader consumer story? Do consumers start to pull back on air travel spending, given some of these horrifying images that you're seeing on your screen? Will that impact consumer travel? Will consumers start to Google whether or not the plane that they're getting on is a 737 MAX? And will that impact some of the spending picture that we're seeing? And what does that mean for the Fed, right? What does that mean for our macroeconomic picture? You can see here on the screen, Boeing down 8% on the day. Again, the worst performer in the S&P year to date off of that news. And that news, again, is going to continue to dominate the airline stock story, Josh, throughout the rest of the week.
Yeah, and the stock did take a leg lower into the close on that headline when it dropped. So investors are clearly monitoring it. You know, it's a tough start for the airline industry broadly, Madison. As we start this year, you started with headlines of those planes colliding in Tokyo, and now, of course, this news of this midair emergency. So to your point is well taken, to the extent that begins to affect how people feel about flying, the safety of flying. We did check in with some analysts in the show today, though, at least as they continue to monitor it. And this is this story keeps evolving, but they seem to both believe their initial gut was that this is going to be kind of a one-off. This would be one panel on one plane, not a bigger, broader issue that would force kind of a redesign here. And of course, that's what you're watching if you're a Boeing investor. How is this going to potentially impact production of those MAX 9?
And we do know that the federal government has really been pushing this, right? Our very own Brian Sozzi speaking with Secretary Pete Buttigieg last week about this, and he asked specifically about some of the FAA news and whether it was going to be impacting consumer sentiment around airlines. And Secretary Buttigieg said they're doing everything they can to make sure that consumers and customers can feel safe on those airlines. So we're going to continue to monitor that story as it comes throughout the week. For now, we're going to get a check on some trending tickers. AMD, as I mentioned, stock riding high today as the semiconductor debuts its new AI-focused desktop computer chip. Now, this chip unveiled at CES, the tech show. It was just a preview designed to handle AI-based tasks without having to send data to the cloud. That's a rivaling factor for names like Apple, ARM, and Intel, and of course, NVIDIA. But Josh, really interesting headline crossing for me earlier today saying this is a new level of the chips war. You have NVIDIA coming out today saying that they are winning the race for AI PCs already, and then AMD also announcing their very own AI PCs at the exact same event. So exactly what we were kind of talking with Brent about in our last block. Do we start to see another round of euphoria for these names as they start to announce new products related to the AI boom? And what does that do to the Magnificent Seven? Do we start to see a shakeup in what those seven names are and what they look like heading into the rest of the year?
Yeah, and our colleague Dan Howley has a great write-up on this news today, by the way. And as Dan notes, kind of the AI PC revolution is really seen as the next potential big growth area for the PC industry, which is why now you're seeing so many names, AMD, Intel, Qualcomm, all debuting their own laptop chips with AI capabilities. Now, of course, it's kind of up to developers, right? Create the awesome apps that leverage those processors and wow Madison and Josh.
Right, of course.
AMD, by the way, what a run. Stock's up more than 100% in the past 12 months, and the street still loves it.
Wow. Yeah, great year for them.
So I'll move on here. Shares of DoorDash moving to the upside today. That's after a positive note. Jefferies marking it as a top pick, upgrading the name to a buy from hold. Firms say they expect the online food delivery company to double its EBITDA in the next 2 years. So that was really the move here. That's the team at Jefferies. They name it a top pick. They upgrade to buy. Their target goes to 130, and they bet that EBITDA will double in the next 2 years. So that's referring to earnings before interest, taxes, depreciation, and amortization. And they think it's a positive is the potential for DoorDash to improve earnings from international operations, Madison, and new lines of business like grocery delivery.
Yeah, it's interesting to see a lot of upside for this name. You were mentioning that all of us might have been sleeping a little bit on DoorDash up. I think you said over 100% last year, just really doing well there.
Well, it's if you look at the stocks, they made their debut in 2020. 2023 was a very good year for sure, right? It was I mean, huge move, 100%.
Right.
Though, we got to point out the context, still well off its peak, which is around 245 in November 2021.
Sure. Yeah, it's interesting too when you think about DoorDash. The Biden administration is releasing a final rule. It could come as soon as this week. It would make it more difficult for companies to hire and treat workers like independent contractors rather than employees, which obviously costs companies a lot more money. We're starting to see trickling in of this here in New York City, where workers are paid a flat rate, and the apps have transitioned away from their typical tipping prompts, so that could change the way that workers at DoorDash are paid. I'm curious whether that's going to impact this name if that goes into effect this week, because it did see a 10% drop when that news was originally announced.
All right, we'll keep watching. Meanwhile, stocks kicking off the week to the upside with tech stocks leading the way on Wall Street. Joining us now is Jeff Klingelhofer, Thornburg Investment Management co-head of investments. Jeff, always good to see you. Let me get your take on this market, Jeff, because we started off the year kind of bumpy here. And obviously, listen, a lot of bulls were saying after that Q4 rip, Jeff, they expected a pause, a breather. I'm interested, Jeff, where do you think we head from here? You know, and if we could spin forward in December, are we higher, lower, about the same? What do you think?
Overall, I've said for a while, I think the big question on everyone's mind is recession outright canceled or is recession just delayed? I'm firmly in the camp that what we've seen leading into 2023 and now playing through all the way to 2024 is absolutely a more resilient and strong consumer backdrop than we would have expected. But there's important caveats to that. We're also seeing all sorts of data that does point to that slowdown of the consumer, the slowdown of the corporation, right? That overall spending levels are coming down, financing conditions remain tight. And I think that puts me firmly into the camp that if I look forward all the way to the end of the year, I would be surprised if we've outright avoided a recession in 2024. I do expect a relatively mild one, but I think stocks change flat to end the year flat to down a little bit would be my guess.
Okay, so Jeff, where can we start to see evidence of that soft recession that you're talking about? Because if you look at a lot of the economic data, so far so good. So where can I anticipate that and get a little clue as to when that might start to kick off?
Yeah, I think Friday was actually a great piece to cue into, right? So the big non-farm payrolls number on the surface looked very good, but when you dig into it, at the 12th consecutive month of revisions downward, right? That's one of those data points that just gives you a little bit of pause. But then following right after it on Friday morning, of course, was the ISM employment conditions that was outright abysmal. I think if you look forward as well, GDP is holding in, but gross domestic income is trending roughly flat. So on all sides of the coin, you have these very conflicting data points, and usually the downside ones are the more forward-looking ones. And so that's really where we're focused. But I would say broadly, you want to focus on the consumer, the resiliency of that consumer, and focus on transition and default rates, which almost every single month we see continue to trend up continually.
And so, Jeff, given your outlook on the economy, the consumer, what does corporate earnings growth look like to you in 2024?
Not as high as estimates are pointing to. That's certainly true. So I think that's one thing where the market has gotten ahead of itself, right? That coming into 23 on the back of the Fed, the market was anticipating on the back of the fastest and highest rate hiking cycle that we'd have one of the shortest time periods before that first hike and the recession took place. Now, what we're easing into in 2024 is just what would be very historically normal. So roughly 23 months on average between that first hike and that first negative payrolls print, we're sitting at 23 months. So what we haven't seen is an accelerated timeline, but what we don't know yet and what I don't anticipate is an outright cancellation as we look forward.
I'm curious then, we're seeing that flows into cash are far outpacing flows into equities. Where can investors find clarity this week on where the risk is worth the squeeze, right? As we get CPI data, as we get more economic data, more Fed speak, where can investors find clarity about where the risk is worth it?
I think watching that CPI print certainly is key. One of the things that we've talked about in the past, I believe, is looking forward, the Federal Reserve has generally been very proactive in its approach to monetary policy. But the fundamental shift that central banks around the world have is they're no longer trying to push inflation up to trend. They're actually trying to push it down. And so the Fed pivot, I think the market's gotten ahead of itself. I certainly don't anticipate, if we don't see a recession, anywhere near the 5.5 rate cuts that the market's currently pricing in. If CPI continues to print close to 2% or perhaps even slightly below the Fed target, that will increase their comfort zone. If we do see those proactive cuts, I think that's one area where I'll have to reassess just my own outlook. Maybe I did miss it. Maybe it's wrong. So I would say focus on the continued fall in inflation and watch central bank rhetoric closely to see if they really are pivoting or just buying more time.
And so, Jeff, so add it up for us, given your outlook here on the Fed, the economy, the consumer, corporate profits, for viewers who are listening right now, equity investors, what sectors look attractive to you in 2024, Jeff?
I would say focus on sectors that have the deep moats. Focus on sectors where even through the thick and thin, they're likely to continue to grow, albeit at modest pace. Some of the dividend payers, some of the domestic banks with just pristine balance sheets, companies like JP Morgan, for instance, we really, really like. So one of the previous stories was the hype around AI. As we look forward, this feels a little bit like robotics to me. Maybe we're a bit premature in how fast this can really change society, but there's a lot of chip players that are surrounded by AI, but aren't necessarily dependent on all of that forward growth coming in to fruition in the shortened time frame. So really focus on companies with resiliency, a deep moat, and focus on downside protection, because I think the question is unanswerable. I don't know if we see a recession in 2024, but markets aren't pricing one. So the downside is significant if it does come to fruition.
Right, Jeff, it reminds me of be fearful when people are greedy and greedy when people are fearful. Maybe that adage is coming true in the market trade this year. Jeff, really appreciate it. Thank you so much for coming on our show this afternoon to break down all the market moves there. Now, the major averages are closing the day higher across the board. The Dow even posting a gain despite those declines in Boeing shares dragging it down throughout the day. Jared Blickery has the breakdown. Jared?
Best day of the year for the S&P 500 and the Nasdaq. In fact, the best day since the middle of November. Nasdaq up 2.2%. And I think it's instructive when you take a look at the sector action. Who is leading today? XLK, that's tech, that's number one, followed by consumer discretionary and communication services. Those are the three mega cap sectors. So if I show you who the winners are over the last year, guess what? It's the same three. And by windfall amounts, they are above and beyond anybody else here. XLI in fourth place, up 11%. But we want to focus on what's happening today. And in fact, let me just bring this to 5 days. This is the fifth trading day of the year, and you don't see any tech in the headline in the best movers so far. We see healthcare, that's up almost 3%. Then utilities and financials. Then communication services and staples. Aside from financials and communication services, it's for the most part a very defensive setup. So maybe today is changing back into the old 2023 modality. We'll have to see how this plays out. But one more thing I want to strike before I go on is that the first 5 days of the year were actually negative, only negative in the S&P 500 by about 13 basis points. But we have three indicators for January that can predict the price action for the rest of the year, whether or not we end in the green or the red. And so far, the Santa Claus rally, that ended red. The first 5 days ended red. And then for the January barometer, and this comes via the Stock Traders Almanac, we have to wait until we get the results from the entire month. If this does in turn green, that does portend a better setup for the rest of the year. But if all three of these are red, and we'll be bringing these stats to you in real time as they unfold, well, 80% chance that we end the year in the red. That's pretty significant, so we will be paying attention to that. But we want to get back to today's price action. I'm going to go to the Nasdaq, and then I'll hit the Dow where we have Boeing. First, here's the Nasdaq 100. Beautiful action in the mega caps. You see NVIDIA up to a record high, at least a record intraday high. That's up 6.4%. Microsoft up almost 2%. Alphabet more than 2%. So Apple is there with them, and Amazon. And then if you take a look at the Dow, as you were saying, Maddie, because we had that big drop in Boeing, that was really weighing on the Dow for most of the day. You can see Boeing here ending the day 8.03% down. That is the worst day since October 22. So aside from that front, we really didn't have a lot of hugely red screens today. And for the most part, if I take a look at the leaders here, it was really centered on tech. Over the last 24 hours, Bitcoin, guess what? Bitcoin heading for 47, 48,000. Those ETFs are up 5-6%. Then chip stocks doing well. Disruption, New York FANG, which is Mag 7, software, IPOs. You name it, a lot of green today. What did not work was small oil. We had some negative price action in crude oil, down about 4%. So we saw oil stocks down. Defense, that's a Boeing story. And then China, that's its own story as well. So for the most part, very, very productive day.
Yeah, Jared, I'm looking at a chart right now showing that the S&P moved in a literal straight line higher for the entirety of the session today. Jared, really quickly here, I'm curious, to what extent can we anticipate this green on the screen continuing, particularly in those tech names throughout the rest of the week? Typically, when we see those gains on a Monday, does that mean that we're going to close in the green at the end of the week?
I'll tell you what, Mondays and Fridays tend to be one-offs. If I put my day trader hat back on, it's really Tuesday through Thursday, which is the trend. The bulk of the trend for the week that counts. Discounting whatever happens on Monday, Friday, whenever, I would say momentum favors the bulls here. You take a look at the price action that we've seen in tech over the last year. Here's XLK. Let me just show you a one-year chart. You were talking about the S&P 500 from the lower left to the upper right. Guess what? Tech over the last year, very similar story. We did have some consolidation here, but if we were to resume the trend, that would just be normal.
That would be normal, and it would definitely be good news for the bulls, like you said, Jared. Thank you so much. We really appreciate you breaking down all the market moves for us. Now, the consumer is about to get more pricing power, but where will they be spending? We're going to have more from MasterCard's outlook after the break. As inflation cools and supply chains start to normalize post-pandemic for now, consumers are becoming more empowered. And they'll keep spending. That's the takeaway from MasterCard's 2024 outlook, which has made predictions on where and how people will be spending this year and what their top priorities are going to look like. Michelle Meyer is MasterCard's chief economist, and she joins us now. Michelle, thanks for being here. If I'm any indication, the consumer spending remains very strong. But looking far beyond me, I want to talk global here to start us off. When you think about global central banks, they've got a lot of room to cut their interest rates over the next year. What can you tell me about where the global economy stands right now and what that tells us about how things are going to be looking heading into 2024 here?
Sure. So there were a lot of elements that were similar across the major economies coming out of the pandemic. Most of the economy saw central banks that cut very, very aggressively, that provided a lot of stimulus. There was fiscal stimulus. And then that was reversed once inflation showed through. So we're now on the other side of that, whether you look at that in the US or in Canada or throughout Europe, where you're starting to hear the conversation about central banks wanting to cut interest rates, to think about the path forward towards easing some of the easing some of the tightening that was out there. So starting to normalize interest rates, normalize monetary policy. And it's not because it's victory when it comes to inflation, but it's because they are starting to feel more and more comfortable with the trajectory of inflation going forward, that it should be one towards the target, towards a more sustainable environment for the economy. And that, I think, is one of the themes more broadly in terms of the global economy, is that we're still on the path towards normalization, whatever that new normal might look like, which I think the verdict is still out on. But we have not yet found that. And I think that's what central banks are also trying to navigate.
And Michelle, as we think about the global economy in 2024, as an economist, what are the big risks on your radar? Is it geopolitics, Michelle, AI, climate, all three?
Sure, you can certainly add all of those to the list. You can also talk about the fact that, you do have central banks that have to execute a pretty, difficult environment here. There's been a lot of uncertainty in this economic environment coming out of the pandemic. And I think so far central banks have done very well in terms of tightening financial conditions, increasing interest rates without destabilizing the economy, but there's still room to go, right? So we still have to see now the other side of that as they begin to potentially remove some of that tightness, start to ease the level of interest rates with still keeping inflation towards the target. So it's a challenge. There's lots of navigation that's out there, both for policymakers. And on top of that, as you mentioned, Josh, you have all these geopolitical and external factors that are very hard to handicap, but are important to keep in mind.
I'm curious, too, about some of the news we got today from the Federal Reserve Bank of New York. The December survey showing that U.S. consumers' expectations for inflation a year from now are at the lowest level in 3 years. Michelle, obviously that sounds like great news, but I wonder if it's one of those where bad news is hidden in there. Could that mean that consumer spending speeds up and ticks up to a degree that the Fed is not comfortable with?
Well, now, when you look at surveys of inflation expectations, what we've seen throughout the last several years, even when inflation was really quite elevated, is that consumers still expected lower and more stable inflation in the future, which meant that there was still this sentiment of disinflation or low and contained inflation that has remained with consumers this whole time. And I think that's showing up now as well. And that, to me, is actually a good thing. It's a good thing because it shows that consumers are taking, again, back their power to some extent. They didn't anticipate that inflation would remain permanently higher. They anticipated that it was short-term bout of inflation and that we would be able to see an easing of inflationary pressures into the future. And we'll see what CPI shows this week, but I anticipate that it will be aligned with the recent trends, which has been for this moderation of inflation.
And so, Michelle, as you think about the American consumer this year, what's your outlook? Do you think that consumer stays, relatively healthy, resilient?
Yeah, I think the U.S. consumer has shown that they have been able and willing to spend throughout this cycle. And the main reason for that is the strength of the labor market. Look at the jobs report that was released last week. We had over 200,000 jobs created, unemployment rate that's holding below 4%, wage growth that is holding at a healthy clip, now in excess of underlying consumer price inflation, which means we have real purchasing power when it comes to the consumer. So I do think that it's a consumer that still has the ability to spend. It is a consumer that is looking for those moments in time to spend, which goes back to the point you raised before around surveys showing lower inflation expectations. There's definitely an inclination to look for promotions, to look for those periods where their dollars, get them the furthest. But they have the ability to still be engaging and spending in this economy. And that is very important to keep in mind. And most important is to focus on where that labor market is going in terms of driving future spend.
Another thing I'm looking at, Michelle, is what's going on with supply chain bottlenecks. And you mentioned that that's one of the issues that was untangled that's led to that consumer empowerment you talk about. To what extent are you concerned about supply chain bottlenecks that we haven't seen the impact of yet in the Red Sea and the Panama Canal?
Yeah, so we have to be mindful of these risks, and I would argue that's probably one of the key ones. Back to Josh's point around the different risks that are out there, geopolitical risks, external risks, this would be one of them. That you could get some clogged supply chains that would create some potential temporary inflationary pressure. It can make it a little bit harder for inventory management, which is really quite critical for retailers out there as they plan ahead and try to meet those consumer needs. So we have to focus on it. So far, we don't really see much in the way of impact yet, but it's something to keep a close eye out for. And it's really a question of the persistence of those the potential supply chain disruptions.
Michelle, always great to see you. Thank you for joining the show today.
You got it. Thank you for having me.
Stick around, more Yahoo Finance on the other side of this break.
Let's get a commodities check because U.S. crude oil falling nearly 4% in today's trading, reacting to Saudi Arabia slashing prices. The move renewing worries that the market is oversupplied as demand is weakening. It comes amid record U.S. crude production and softening demand in China. Now, what I find interesting about this today, too, Josh, is that one analyst said this is either a demand concern for Saudi Aramco or it's a move to gain market share, and both of those things are bearish indicators for energy prices. And this is also amid a lot of volatility in the space. The market seemed to have kind of bounced back, digested at least some of the geopolitical risks in the Red Sea last week, and then hit with this news from the Saudis this morning, just bringing back down the energy market. Some really bad performance across the board there, particularly when it comes to crude. Crude futures after the close today down just about, I think that says 3.5% after the close. So that's likely to continue into tomorrow as well.
Yeah, and just looking at the oil majors here too, Madison. So Exxon was down in today's trade, so was Chevron. And as you mentioned, oil prices actually climbed last week, and that was on these continued worries, as you mentioned, about kind of conflict in the Middle East, the Israel-Hamas war. But there were two issues today. One, the Saudi news, which is kind of just encouraging these concerns about lackluster demand. And then we also did have reports that maybe some shipping companies would be making a deal with these Iran-backed Houthi militants to get their ships through the Red Sea. Some back and forth headlines I was seeing on that front too. So that news was also being highlighted as pressuring prices as well. Broadly, by the way, we have seen analysts cutting their oil price forecasts for the year. General idea being here, these supplies coming from outside OPEC will be enough to meet growth in demand. Bloomberg actually had a nice write-up on this, knowing that among the 5 big Wall Street banks, only Bank of America, they pointed out, anticipates significant gains this year, forecasting an average of 90 a barrel. Citi, the most bearish, they said, predicting an average of about 75 a barrel.
And that's a big deal when you consider that there are some other names in there. I'm thinking about a JP Morgan, for example, that's usually pretty bullish when it comes to oil, and even they are moving their price targets down after some of this news. Also want to mention a survey from this morning showing that oil production last month by members of OPEC had also declined, or had also risen rather. So that's going to increase supply in this space, which is not good when you're seeing some weakening demand. That's also going to drive down some of the trade that we're seeing today when it comes to oil prices.
For sure. Meanwhile, moving on here, our Anjali Kamlani is in San Francisco this week at the 42nd annual JP Morgan Healthcare Conference. She spoke earlier today with Eli Lilly's CEO on the company's growth outlook heading into the new year. Part of that conversation right here.
We've been in this space a long time, as you mentioned. You said GLP-1s, but now we're actually adding other gut hormones, incretins we call them, together. So tirzepatide, which is Mounjaro, and Zepbound is 2 modes of action, GIP and GLP. And in the pipeline, we have another one coming with 3 modes of action. So you can see we're now learning how to exploit this biology to really affect a whole number of metabolic diseases. So last year was about the launch of Zepbound introduction. That happened in the fall, I think going well so far. Mounjaro had a great year as well in diabetes. Trulicity, our older product, continues to do well. This year, I think, will be about some of the new data releases as we study these drugs, not just to demonstrate they lose weight, which almost everybody loses weight, but what happens to your broader health. We're studying a population with congestive heart failure, a specific subtype called HFpEF, which is a partial ejection fraction. And that's really driven by obesity, so we're really anxious to get those results sometime in the second half. And then also a condition called sleep apnea, which is a common condition that almost 10 million Americans have, that we think we can reduce those signs and symptoms of sleep apnea by losing weight on tirzepatide. So this will be now the next step, to translate those health benefits with great weight loss.
Yeah, absolutely. Certainly something we're all looking at, right, is how much more can you get, what other diseases can get benefited by the work that you've been doing. I also know that you launched Lilly Direct. You're trying to get to the consumers. We saw how much of a run you had on just Mounjaro alone last year. These drugs are in high demand. You're running out at some points in the year. So launching Lilly Direct, getting to the consumer, directly to them with Zepbound first, and then a couple other of your diabetes drugs. What is the goal? Are you trying to cut out the pharmacies and the PBMs here?
We're not trying to cut out anyone. We're happy to work with all those players. What we're trying to do is optimize the patient experience. And we listen carefully to the patients that want to use our drugs or are using our drugs. they're pretty frustrated with the state of U.S. healthcare and how it works for them. So we're trying, with Lilly Direct, trying to do three things. One is the direct part, which is get supplies or products from a manufacturer directly. That's an experience we all have in many parts of our life, and some people prefer it. I would say in particular, people with obesity, who when they go out into the world are often shamed for the way they look. Many people don't consider obesity a health condition. They get blowback at the pharmacy counter, et cetera. So they in particular like the discretion of getting that product directly. Secondly, telehealth, which a lot of Americans had experience with in COVID, and some don't like and some do. So here we're serving up a partner in different disease states, actually 3 different partners, who are good at telehealth, and people have a place to land to get that. And why do we do that? Because we've worked with them in various ways to make sure the quality of the programs are very high. And so Lilly can be a trusted source to get that telehealth provided.
Absolutely.
And then, I think the other thing I would say is, in particular with obesity, here again, patients report kind of doctor shopping to find someone who will write them what they know is a solution for their health problem. And so here it's just more convenient. It's not just, though, telehealth. We have a doctor finder tool on our site, so you can put in your zip code and find out who is a certified obesity specialist in your area. And access to healthcare and that knowledge gap with patients and the healthcare system is pretty vast in the U.S., so here's a way to bring that closer together.
That was part of Anjali Kamlani's interview with Eli Lilly CEO Dave Ricks at the JP Morgan Healthcare Conference. And up next, we're looking at the Bitcoin ETF race, issuers detailing their fees as we wait for SEC approval. With the Securities and Exchange Commission deadline for spot Bitcoin ETF approval fast approaching here, a bidding war between potential issuers is heating up. Regulators must decide on ETF approval by Wednesday, and a race to the bottom is forming among issuers for the lowest fees. Joining us now is So-Young Kim, Santa Clara University Levy School of Business Associate Professor of Finance. So-Young, it's good to see you. So the news today, these potential ETF issuers, So-Young, for these, giving us more details about their proposed funds, including fees, So-Young. And so I was just interested, did anything surprise you about those fees? And how do you think they ultimately, So-Young, impact and shape demand for these products?
I think so let's start with the fees. The most interesting and shocking part to me is that Grayscale has, obviously they are going to lower their management fee for a spot Bitcoin ETF, but right now they're charging 2%. And what they had announced is they intend to drop it by, we talk in bips, and 1 bip is 1 basis point. That's 0.01%. And they're talking about dropping it 50 bips, which is 0.5%. Now, that sounds very unreasonable when other types of large asset management institutions enter this space. Something between 20 to 50 bips or 0.2 to 0.5% could be reasonable for something like this, where the management fee would naturally be higher than it would for something like a passively managed index, where really you would only want to see 10 to 15 bits. But with Bitcoin, the execution and also the custody issues are very different. And so it makes sense to charge a little bit more, but charging 1.5% per year as your management fee seems very steep.
It seems very steep, and it makes me wonder if investors are going to flock to a name like BlackRock, which is hovering around 0.3%. Do you anticipate that BlackRock could end up the liquidity king here, given that they have that name recognition and the fee structure might encourage others to have to come down and meet them in the 3 zone?
I think it all comes down to who do you trust the most in terms of having the expertise to get a proper custodian in place, and also who the authorized participants or the APs are going to be. And because BlackRock, even though they're not already established in terms of having any sort of spot Bitcoin fund already, like Grayscale already has, BlackRock is such a trusted behemoth in asset management in general. And so consumers will ultimately look for trust in an institution, but also price. And 1.5% is really steep.
So So-Young, is that how we should be operationalizing this from an investor perspective? Is it that combination of trust and price, or are there other factors that investors should put into their equation when they're determining which ETF to go with here?
I think for most investors, as long as it's an ETF issuer with a large name that you trust, your BlackRocks, your Barclays, those types of institutions, I don't think that most retail investors are well versed to think about who an appropriate authorized participant would be in this space and what appropriate custodianship looks like. And so you really want to go with trust in the issuer and then look at what the fees are and compare. I mean, price shopping is very easy these days. This has also happened in standard index funds where even 10 to 15 years ago, there were a lot of passively managed plain index funds that were charging 80, 90 basis points. And today that is absolutely crazy. People are more educated and price shopping is far easier now than it used to be.
And So I have 2 questions for you. I'm going to double barrel it. One is consensus, So-Young, as you know, is the SEC is going to greenlight these spot Bitcoin ETFs. One, I just want to check with you, is that your feeling? Do you think, in fact, the SEC will approve these new products? And secondly, So-Young, if and when they do, what do you think demand is going to look like, and where do you think that demand comes from? Is it retail, institutional, RIA?
I think it's not a matter of if, but when. It may not happen this week, but this has been in talks for quite some time, for years. And before that, people were trying to start a Bitcoin futures ETF. That raised some questions and concerns in the beginning, but we've had Bitcoin futures ETFs for a while now. And the next step is to have a spot Bitcoin ETF, as long as you have the faith that someone knows how to put and operationalize this appropriately. And the large players that are in place now are far better versed in this crypto space than they were even, let's say, 6 or 7 years ago. So I think there's a lot more faith in the execution and operationalization of this. But going back now to the other point of, I think you were asking how large this would be, or who would be interested?
So Young, when they do, like, I just want to get your take. What do you think demand is actually like from these products? And where do you think that demand would be coming from?
A lot of people who own crypto, when I used to give talks, I would ask, who has ever owned crypto? And 7 years ago, there'd probably be a few hands in the audience. And now it's more than half regularly. People have at least owned or touched crypto in some way, but they still don't know how to actively purchase crypto without the help of a custodian in place who is going to keep those assets for them. So we keep learning and relearning that we are not good at being our own banks. A lot of people simply buy Bitcoin on Coinbase and then leave it on Coinbase. So Coinbase is serving as their custodian. If you're in that camp, why not go through a trusted asset management fund or an asset management firm? And with an ETF, it will be far more liquid and easier to sell in a traditional environment, very different from the way that you would go onto a crypto exchange and buy Bitcoin directly now.
It sounds like you're saying you need good investor hygiene when it comes to an asset class like this one. Given that, what do investors need to keep in mind who do go with some of these ETFs moving forward? What should they be thinking about when it comes to their activity with these spot Bitcoin ETFs?
I would say it really goes back to, well, the trustworthiness of the issuer, then the management fee, but also the size of the fund that's being put together. So the AUM for the particular fund is going to be important. If it's too small, then the APs that are in place may not have the proper incentives to step in, because an AP doesn't have to step in, and that would quickly become a concern depending on whether or not there was proper incentive. But also you want to think about, are these, in terms of when someone is trying to start a spot Bitcoin ETF, we want to make sure that they've properly documented the concerns in finding an AP for this type of ETF, because execution is going to be very different for these APs than it is for an ETF that simply tracks an index of public equity securities.
Right. Definitely important to keep that in mind. Really appreciate it, So-Young Kim. That was great. Thank you so much for giving us kind of a breakdown of what investors should be thinking when it comes to these spot Bitcoin ETFs, pending approval, of course, from the SEC. Now, coming up, what to watch tomorrow. We're going to break down the stories that you need to know to start your day heading into Tuesday.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Yahoo Finance is here in Sin City, Las Vegas for CES 2024. It is one of the largest tech conferences in the world. I'm Akiko Fujita. I'm here to guide you through some of the biggest tech and new ideas that will help transform your investment portfolio in 2024. Let's take a look inside. The conference officially kicks off on Tuesday, but we're here inside CES Unveiled to give you the inside scoop. Hello. Nice to meet you.
Hello. Nice to meet you too.
Ready? How's my form? Fourth time, here we go. Here are the three themes defining this year's big tech event. First off, artificial intelligence. All the companies are showing off their latest innovations. We are at the booth for Barracuda. It's a French health tech company that's developed this mirror. It's an interactive mirror that uses artificial intelligence. It listens to your voice and then determines your mood.
How's your day been so far?
My day has not been great, and I haven't gotten a lot of sleep.
We all have our moments of feeling down. It's essential to acknowledge it. Just like a rainy day makes way for sunshine, your mood can improve.
The second theme, auto tech. The world's largest car makers are coming here to unveil everything from autonomous vehicles to flying cars. We've all heard about self-driving cars. This company, Glückskin, is building self-driving strollers. It's rocking the baby. Something every mother can appreciate, every father can appreciate. So you see the light here? The green light here shows that it's on, and if I press it a little, it'll stop to make sure the baby does not run away. And finally, theme number 3, the fun and unique tech you won't see anywhere else. We are in front of the Patch XR booth. You see, this guy is inside virtual reality. The company is a mixed reality software company. It allows users to build all the tools to create music in virtual reality. They partner with musicians. They let you create drum sets. I mean, this guy's got it going. I'm gonna give it a shot. All right, here we go.
All right, here we go. Yeah.
Okay, now we've got multiple layers of beats going. Oh wow, look at this. I feel like I'm sitting in first class. This is just what I need right now. Oh, I'm supposed to kind of tickle it. We're gonna be here all week. Don't miss our interviews with the top tech leaders and demos of the latest gadgets. Oh my God, 13 more minutes. 19 minutes left. He's able to type, right, just by looking. Can we have him spell Yahoo Finance?
Sure.
Yahoo Finance is on the ground for CES 2024. Join us Tuesday through Friday for all your coverage.
Well, I could watch Akiko at CES for the rest of my life, but here's what we're going to watch when it comes to the markets tomorrow. It's going to be one of the biggest days of the calendar for tech fans. Thousands of developers at CES with our very own Akiko in Las Vegas for the electronics trade show. Now, dozens of companies going to unveil new products, many of which will be incorporating, of course, the latest in AI. Yahoo Finance is going to be on the ground, so be sure to tune in tomorrow to hear from both Qualcomm and Honda on their latest developments.
And on the political front, former President Donald Trump is expected to appear at the U.S. Appeals Court. First arguments will be heard on his claim of immunity to charges he illegally attempted to overthrow the results of the 2020 election.
And we have earnings from Albertsons companies before the bell. The Street thinks the grocery store chain will report a decline in third quarter profits compared to last year as retailers send mixed signals on slowing inflation and consumer spending.
And speaking of inflation, we will hopefully get more insight on the Fed's next move as its vice chair for supervision, Michael Barr, will speak tomorrow.
Heading into Tuesday's market open, I'm going to be watching aggregate finance numbers expected to come out of China. And what's really interesting about this, Josh, is that this is going to give us the latest look at China's credit supply. So this tells us how much money the government there is pumping into the economy. This has been a critical thing to watch, given that the rebound following the pandemic in China in terms of the consumer spending has not been as robust as we anticipated. That aggregate financing number rose to 9.4% in the previous print. We're we're expecting to see continued growth in that print moving forward, which would indicate that the Chinese government is still feeling the need to kind of put more stimulus into the economy there.
Yeah, I mean, certainly, the economy there is still shaky. More in focus now with earnings season just ramping up. I think more investors are paying attention to that and what kind of impact that's going to have on earnings for sure. I am watching, you went very high level there on me, very CFA, which I'm going, I'm trying
to be impressive. I'm here for the day.
I'm going to talk groceries, for example. Albertsons talking tomorrow, Q3 results. We're looking for adjusted profit, 65 cents a share, revenue of $18.4 billion. Some key themes there to watch. The consumer. What does Albertsons have to tell us about the state of the consumer? How healthy, how resilient? Deflation, Madison, another theme on the radar. Remember, Walmart execs brought that up in November. So what does Albertsons have to tell us there? Pharmacy business, we know, will be in focus as well, given that pending merger with Kroger. Analysts noting Albertsons will not be hosting a conference call, so the street not expect a whole bunch of news or info there. 8 buys, 12 holds, no sells heading into this print.
All right, I love to get the call because we remember Kroger talking a lot about AI on one of their previous calls, so unfortunately we won't get the AI mentions from Albertsons tomorrow.
Well, wait, we'll see what happens.
We'll see what happens.
Anything
Maybe
could
they'll
happen,
surprise us.
Yeah. No idea. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.